Hi, this is Mijun from Mijuron University. Let's begin today's Big Jew City news for November 25th. Welcome to Mijun, where we continue to uphold the fundamentals of United States stock investing, as always. Today, I'd like to start with a brief announcement for our Mijun members. Yesterday, the Mijun membership manager posted an announcement, and it's about today. On November 25th, there will be an exclusive live broadcast for the Mijun All-in-One membership. If you click on this post, you'll see the live broadcast link right at the top. You just need to join through this link by 9 post-meridian Korea time on Tuesday night. And for those who can't join the broadcast at this time, you can watch the recorded broadcast later by clicking this link. Please keep that in mind. And for those who aren't members, it might be a bit disappointing. I suggest you try the membership, even if it's just for a month. You can also sign up for a 1-month membership. So for those who have never tried the membership before, monthly membership is 49,500 won. So you can try out the membership for a month, and if you feel that this membership is really necessary for you, you can continue with it long term. If you feel that the membership isn't as valuable as you thought, or it's not worth 49,500 won, you can just sign up for 1 month and then cancel. From my perspective, I expect that once you join, you'll probably stay with us until the end. Anyway, I hope many of you will join today's Mijuon membership live broadcast. All right, then let's get started with today's Big 2 news prepared for November 25th. Today as well, let's start by reading the comments left by our valued subscribers and members. Yesterday's Mijuon broadcast was a bit more popular than usual because the thumbnail was a bit provocative. I sold all shares of one of the top picks from Mijuon. After I shared this news, clicks suddenly surged. While I was reading the comments you left yesterday, a thought occurred to me. So I felt that I really needed to mention this part once again. So today, I'd like to share with you some of the thoughts I had. First, I'm going to read a few comments. Someone with the username Mendelov97 said this. You sold all of your MicroStrategy MSTR shares. I have 100 shares, so I can't sell them. If you have 100 shares, that's a significant portion of your investment, so I'm not sure why you say you can't sell them. And Mr. Kim Jin-chang said, I understood after listening to the broadcast and sold all my MSTR shares. He said that his heart hurts because he sold. So that's why he's feeling this way. Honestly, I can't really relate to this part either. Because it's not selling all your shares that hurts, it's when the stock price drops that it really hurts. MicroStrategy's stock price has dropped more than 50% over the past year, so it makes sense that you'd feel bad over the past year. When you sell everything, it's actually more natural to feel nothing. That's what I think. And I'll read one more message. Kevin Brown asked, what about the losses? That's the question he asked. And as soon as I saw this question, what came to mind was, selling the stocks resulted in a loss, reminding me again how people think. Here's the key message I want to share with you all. A loss happens when the stock price drops, not just because you sold your stocks. That's what I really want to tell you. Yesterday on the broadcast, I even revealed all the details of my investment strategy. So the biggest reason I sold strategy yesterday was because of this. I'm expecting the price of Bitcoin to rebound in the future, but even if the price rebounds, strategy's stock price might not fully reflect that rebound. The reason we invest in strategy instead of just holding spot Bitcoin is to take advantage of the leverage effect. So when the price of Bitcoin surges later, it should create a much stronger upward trend than just the increase in Bitcoin's price itself. There was concern that it might not be able to do that. So yesterday, to take advantage of this effect, I chose something with relatively less risk than a strategy. Instead, I said that I moved my funds to another stock where I could fully benefit from the leverage effect. So the stocks I mentioned were things like B2 and Bitmine, right? And as a result, this strategy worked. Yesterday, MicroStrategy's stock price surged by 5%. Check out these results. Some people might say, Mijihoon made another mistake. He sold before the strategy stock went up. It rose by 5%. His timing for selling wasn't good. You could say things like that. But the important thing is, after I sold strategy yesterday, there were 3 stocks that I bought. The first one was Bitmine. The stock price went up by 19.62%. And I also bought a small amount of ETHT, which tracks Ethereum, and it went up by 17.04%. And finally, I also bought B2, and it went up by 10.7%. The main point I want to stress, as I always do, is that stock investing relies on relative evaluation. So it's not important whether the stock you have will go up or down in the future. Jihoonmi's trading status. The reason I'm selling this stock is not because I expect its price to fall in the future, but because I see another stock with a higher probability of rising and lower risk than this one. I always make sure to say this. So the reason I sold strategy yesterday is not because I expect strategy's stock price to fall in the future. It's not that kind of expectation or prediction. I move my funds because I believe that stocks like Bitmine, ProShield's UltraRider, or BIT, which are showing similar effects to strategy, actually have less risk and their stock prices could rise more noticeably. I want to stress this point. Also, there's one more thing I'd like to add. I hope you avoid thinking that just because you haven't sold your stocks, you haven't taken a loss. That's why questions like, what happens to my losses only when I sell my stocks, come up. Selling or holding your stocks results in the same loss. Because like I did yesterday, you can sell that stock and buy another stock with it. Just because you're holding on to it doesn't mean you haven't lost. I want to stress this again. Next, I'll summarize the market conditions of the United States stock market from yesterday. As always, we'll first take a look at the S&P 500 map. Just by looking at the S&P 500 map, we can get an overview of the current market situation at a glance. As you all know, yesterday all 3 major indexes surged. The S&P 500 rose by more than 1.5% and the Nasdaq jumped by more than 2.6%. The reason for that is something we can easily see here. It's because the megatech companies, the 7 stocks we call the Magnificent 7, all surged at the same time. So overall the index rose significantly. However, there's one thing that's a bit disappointing. In other sectors, you can see a lot of red. What that means is, yesterday's rally was actually concentrated in tech stocks. That's how you should see it. The best scenario is when all sectors and all stocks rise together at the same time. I explained before why that's good, back when I was talking about a downturn. At times, only tech stocks were in the red, while others were in the green. At that time, I told you there was no need to worry and gave you that message. Because when only tech stocks fall and other sectors go up, that's a rotation of funds. A rotation of funds means that liquidity hasn't left the market, so we can interpret it positively. For the market to keep falling and falling, the money in the market has to keep decreasing. In other words, liquidity has to decrease for the market's decline to continue getting bigger. But when this kind of rotation happens, it just means that funds are moving from one place to another, not leaving the market. That's how you should see it. But yesterday, on the contrary, the stock market rose all at once. So what I was secretly hoping for was for everything to be in the green. If that happens, it means additional liquidity has come in. So it's best when a lot of money from outside the market flows in and all stocks and all sectors go up. But unfortunately, yesterday, there were many sectors and stocks that fell. That means there was a kind of rotation. Therefore, it can also be interpreted a bit negatively, as liquidity did not suddenly increase dramatically. Anyway, yesterday there were more rising stocks, and since tech stocks surged, the overall index movement was very good. Especially the Nasdaq 100 performed the best, rising by 2.56% because the megatech companies soared. Microcap stocks also rose by 2.13%, showing the second best trend. Below you can see sector performance. Yesterday, technology stocks led the way with a 2.38% gain. Consumer discretionary, including Tesla and Amazon, rose 1.33%. Recently, many artificial intelligence beneficiaries have emerged in utilities. So yesterday, it went up by 1.13%. Lastly, with Meta and Google surging, communication services also rose by 0.9%. Conversely, energy, consumer staples, and essential consumer goods declined. The remaining sectors actually showed very small gains, so there was a big difference in performance by sector yesterday. That's how we can analyze it. Next is market breadth. It's 41 and 35. Yesterday, it was 39. So considering that the index jumped up yesterday, the market breadth didn't really widen much. This part is still negative. As I mentioned earlier, market breadth must keep rising to 50, 60, 70 and beyond. Overall, we can expect the upward trend to continue. Next is the volatility index. It dropped sharply. As you can see, it dropped to 20, even down to 5th place. Just a few days ago, it had surged to 26 or 28. So if it drops just a little more now, it could fall below 20, and there's also a possibility that it could drop below the 20 zero-day moving average. Next is the fear and greed index. As I explained yesterday, it's still in extreme fear. However, the extreme fear level, which had dropped to 6, went up to 10 yesterday, and now it's trying to rebound further up to 14. Therefore, the current trend is showing continuous signs of recovery. However, in my personal opinion, it's still too early to feel relieved. Let's review Mizon Top 17's performance. B2MINE led with a 19.6% increase. ULTRA ETHER Exchange Traded Fund ETHT tracking. Ethereum rose 17.04%, Celestica gained 15.17%, Credo 13%, Broadcom 11.1%, B2 10.7%, Micron Technology 7.99%, Tesla 6.82%, Coinbase 6.47%, Google 6.31%, Advanced Micro Devices 5.53%, Palantir 4.78%, Volsula 3.98%, Talent Energy 3.97%, Taiwan Semiconductor Manufacturing Company 3.48%, Meta 3.16%, and Nvidia 2.05%. And although Bitcoin and Ethereum are shown as negatives, in fact they have risen sharply. Bitcoin has climbed up to 87,500 and Ethereum is showing a recovery trend at 2,911. Let's continue to today's main article. In today's broadcast, I'd like to talk about one of the hottest topics on Wall Street recently. You've looked at the performance of the Mijun TOPIC. Actually, considering NVIDIA's recent earnings, yesterday's 2% rise is a bit disappointing. Even though many artificial intelligence beneficiary stocks have tried to surge like this. Let's review this article to see why NVIDIA stock price rose only modestly. We'll also check the future trends of NVIDIA's stock price together. Yesterday, there was news that NVIDIA issued a memo refuting accounting allegations. Let's read this article together first. Large-scale stock sell-offs are causing artificial intelligence beneficiary stock prices to fall. And another thing, due to the recent accounting fraud allegations, NVIDIA has found itself at the center of debates about the value of artificial intelligence-related stocks. And now, the article begins by saying that NVIDIA has finally started to fight back. Last weekend, NVIDIA's investor relations team sent a 7-page confidential memo to Wall Street analysts. NVIDIA directly addressed 12 claims raised by skeptical investors, so you can see it that way. Recently, NVIDIA's stock performance has been a bit sluggish, and that's because there have been so many rumors and suspicions being raised. So this memo, it started by mentioning Michael Burry's social media posts from last week. Michael Burry, he criticized NVIDIA for shareholder value dilution due to stock option compensation and for their share buybacks. Michael Burry, who appears here, is a very famous investor, and he's also known as a specialist in short selling. He was also portrayed as the main character in the movie The Big Short. He foresaw the subprime mortgage crisis before the 2008-2009 financial crash and made a fortune by short selling. That's how it happened. So whenever this person speaks, a lot of people pay attention. Nvidia stated in the memo that they have repurchased 91 billion of their own shares since 2018, not $112.5 billion, making $112.5 billion incorrect. That's what they said. They explained that Michael Burry seems to have mistakenly included taxes on restricted stock units, or RSUs, in his calculation. They also pointed out that stock-based compensation granted to employees should not be linked to the results of the share buyback program. And they added that just because employees benefit from a rise in stock price, it doesn't mean the initial stock grants at the time of issuance were excessive. This part is a bit complicated, so I'll explain it again in a much simpler way in just a moment. Michael Burry had an interview with Barron's yesterday. He announced that he does not agree with Nvidia's response and stands by his own analysis. He also said he'll discuss the company's stock-based compensation in more detail in future reports. So he once again confirmed that he will not slow down his attacks on Nvidia. What about Nvidia? The current situation involves suppliers, finance, and SPUs, special purpose units. So they create one more of these to reduce taxes. It's like creating a kind of shell company. Past accounting fraud cases with these characteristics include famous examples like Enron, WorldCom, and Lucent. Of course, they responded to the claim that this is similar to those cases. But in my opinion, when you use such dramatic examples to criticize something, it actually becomes less effective. It was bound to lose credibility since Nvidia differs greatly from companies like Enron or WorldCom. So this memo, Nvidia's core business is economically sound. Our reports are complete and transparent, and we place great importance on our reputation for integrity, so we are different from past accounting scandals. This is what was emphasized. And also, unlike Elon, Nvidia does not use special purpose entities to hide debt or inflate revenue. This was the strongest point of emphasis. That's how you should see it. Nvidia also addressed suspicions that its major tech company clients are not properly accounting for the economic value of Nvidia hardware. This part is quite special because, in fact, this criticism isn't really directed at Nvidia. It's actually aimed at megatech companies like Amazon, Microsoft, Google, and Meta, but Nvidia ended up making excuses on their behalf. That's how you can see it. Some companies use a 6-year depreciation schedule for graphics processing units, or GPUs. But what Michael Burry said was that he thinks the useful life of a chip is shorter than 6 years. Therefore, he argued that Nvidia's customers are inflating their profits by spreading out depreciation expenses over a long period. So what Michael Burry was saying is this. He says that the lifespan of these GPUs is usually 3 years or 4 years at most. Now, let me briefly explain how this relates to the company's performance. Depreciation comes into play here. What this means is that there are two types of expenses. The first is what we call operating expenses or operating expense. This goes directly into the income statement for that quarter. But aside from this, there's something called CapEx. CapEx refers to large amounts of money invested for the distant future, and this doesn't go directly into the income statement. Due to the large amount, it's initially recorded as an asset. Of course, cash goes out, but the expense is recognized later through depreciation as the value gradually decreases. That's how you should see it. But what Michael Burry is saying now is that the lifespan of a GPU is 3 years, 4 years at most. So let's assume the value of a GPU is 60 million won. Then when you depreciate 60 million won over 3 years, 20 million won disappears each year. Then you have to count 20 million won as an expense every year. But now some companies, that is mega tech companies, are setting the depreciation schedule to 6 years. So if you divide 60 million won by 6, the annual depreciation expense is only 10 million won. Michael Burry's point is that they keep inflating their earnings like this. In response to this, Nvidia says this in a memo. Nvidia explained that their customers depreciate GPUs over 4 to 6 years based on actual lifespan and usage patterns. And also, the reason the A100 is mentioned is because it's a chip that was released in 2020, so it's been over 5 years since its launch. These older GPUs are still being used at a high utilization rate. It's generating strong park profit. Therefore, there are still many companies using the A100, and many companies are generating revenue and making profits with this GPU. Therefore, they argue that its lifespan is still valid. Therefore, they added that it maintains significant economic value well beyond the 2 to 3 years that some commentators claim. Here is the article content so far. Let's summarize it in one sentence, including Mijun's comment. The debate between Michael Burry and Nvidia is a bit complicated. I'd like to explain this in a very simple way. First of all, Michael Burry's main point is that they are deceiving shareholders. That's his main message. Michael Burry's criticism boils down to two main points. They're issuing too many shares, diluting existing shareholders' stakes. The main point is that share buyback figures have been inflated. Let's examine the value dilution from stock compensation. Nvidia gives a lot of company stock to employees instead of salary, which we call stock options. So what Michael Burry is claiming is that to give stock to employees, the company has to issue new shares. And this can be explained like slicing a pizza from 8 pieces into 10 or 12 pieces, making it smaller and smaller. As the number of pizza slices increases, each existing shareholder's slice gets smaller. Therefore, it can be interpreted that Nvidia is eating into the shareholders' pie to take care of its employees. We call this dilution in technical terms. So if the number of shares issued keeps increasing, the value per share will inevitably decrease, resulting in a dilution effect. This is the first criticism. Let's move on to the second point. The second criticism is that the scale of the share buyback has been exaggerated. First, let's summarize the situation. Nvidia announces every quarter that they've made money and are buying back their own shares, saying they do a lot of share buybacks. And as you all know, when a company buys back and cancels its shares, basically when they retire shares, the total number of shares decreases, which is positive for shareholders. That's the opposite of what I explained earlier, but Michael Burry argues differently. If you add up all the money Nvidia has spent on share buybacks since 2018, it comes to $112.5 billion. But check if the number of shares has actually decreased by the amount corresponding to that $112.5 billion. The answer is no. So, because they gave out so many shares to employees, the share buybacks were merely a defensive measure to offset the increase in shares caused by the stock given to employees. Even though they bought back their own shares, the share count didn't drop because of it. That's what they're saying. Therefore, they're criticizing that the numbers you announced don't match the actual effect. Now, let's hear what Nvidia has to say about this. Nvidia privately rejected Michael Burry's claims, citing a calculation error and concept confusion. Now, regarding the first $112.5 billion, they argued that the calculation was wrong. Michael Burry said that Nvidia spent $112.5 billion on share buybacks, but in reality, it's $91 billion they claim. Michael Burry, it seems like they included taxes related to restricted stock units in the share buyback amount. So this is an incorrect number. Paying taxes and buying shares are clearly different things, so why did they combine them? That's the question. They're inflating the numbers to attack us. The calculation is wrong, so recalculate and come back. That's what was said. Second, it's true employees made a lot from stocks, but that's because it became a 10-bagger, 20-bagger, or even 30-bagger. It's not because we gave out too many shares at first, but because the company did well and the stock price went up. That's why the employees became wealthy. The employees became wealthy because the stock price went up. They argue it's unreasonable to call the stock compensation program flawed from the beginning. Let's stop. I don't know whose opinion you think is correct. In times like this, we need to look at the numbers. I'll show you a graph. What this shows is the change in the number of NVIDIA's shares from 2001 to 2025, starting from 2020. As you can see, is it May 1st, 2022. Up to this point, the number of shares kept increasing, and from here, the number of shares is gradually decreasing. As you can see in the graph below, the total number of shares, here it's based on dilution, which is more accurate. Anyway, the important thing is that on an annual basis, it's on a decreasing trend. We can see this part. When we actually look at the numbers, in 2022, the number of issued shares was 25.37 billion. That's 2.537 billion shares. But this figure, in 2023, it was 25.37. In 2024, it was 24.94. And recently, it dropped to 24.48 billion. The reason for the decrease is, of course, share buybacks. In other words, when a company actively buys back and cancels its issued shares, the total number of shares can decrease. That's how you should see it. So if you just look at these numbers, things are actually moving in the opposite direction of what Michael Burry claims about dilution increasing. We can take a look at this part, but there's one thing you need to be careful about. The share count covers options, RSUs, and unexercised shares. So, if there's an increase in stock compensation or more options are exercised, there's a possibility that the number of diluted shares could actually increase in the future. So while that wasn't true before, as options are exercised gradually, the share count could rise. That's how to view it. So the potential dilution risk from employee compensation that Michael Burry is talking about can't be completely resolved just by looking at this number. We need to closely examine the link between fewer shares issued and higher employee compensation shares. We need to monitor if the number of diluted shares increases in the future. But at least since 2022, it's true that the total number of NVIDIA's shares has continued to decrease, which has benefited us shareholders. So far, we've analyzed things numerically. Now let's examine market and NVIDIA analyst reactions. NVIDIA released an unusually long 7-page memo this time. They used the Elon situation as an analogy and refuted Michael Burry's claims point by point. But how did the market react? Initially, there was relief, but some doubts remain unresolved. What did Michael Burry, who initiated the attack on Nvidia, say? He didn't back down even after Nvidia explained. On the contrary, he said he doesn't agree and stands by his analysis. And also Michael Burry, he didn't just stop at disagreeing, but also announced that he would publish another report in the future to address Nvidia's stock-based compensation issue in more detail. So based on this, Nvidia's explanation is not the end of this controversy yet. This suggests that the second round of disputes may begin. So we've summarized the views of most analysts on Wall Street, and Wall Street welcomed Nvidia's explanation, but they're still being cautious about the accounting issues. Most analysts are. Nvidia doesn't fabricate its sales or use special purpose entities to hide debt, so comparing Nvidia to Elon is a bit much. So far, everyone seems to agree on this. That's why they're not talking about accounting fraud. However, the debate over the depreciation period continues. Artificial intelligence chips are developing at a very fast pace. But is it really reasonable to set their lifespan at 6 years? What are your thoughts on this? Even though Nvidia has given an explanation, it's likely that this issue will continue to be discussed. Now, let's move on to the comprehensive analysis. What about Nvidia's memo? They've handled the immediate issue for now. Yesterday, the United States stock market surged, largely driven by artificial intelligence-related stocks. Do you think Nvidia's memo might be one reason? But even so, Michael Burry has announced that he will release an additional report. Therefore, market sentiment is still very sensitive to artificial intelligence valuations. There could be further declines, and it's possible that volatility will continue to increase going forward. In the short term, there was a trend reversal attempt due to the memory effect and a rebound in artificial intelligence beneficiary stocks. However, there are technical resistance levels at $186 and $192, and it's a bit difficult to break through them. Let me go down for a moment and show you. If you look here, $192 is the 20-day moving average and $186 is the 50-day moving average. Nvidia's stock price has now broken below both the 20-day and even the 50-day moving averages. So now, in order to create an upward trend again, it needs to break through these two strong resistance lines. This can be interpreted somewhat negatively. So, until it breaks through these two lines and moves upward again, it's a bit too early to say that the trend has turned bullish. In the short term, our personal judgment is that it is highly likely to lag behind the stock price trends of other artificial intelligence beneficiary stocks. And in the long term, ultimately, it will have to be proven by the numbers. The accounting clarification is really just a short-term event. Therefore, what's important right now is how much the market's expectations and the actual performance will differ. In other words, it's most important to keep announcing earnings results that are much higher than these growth expectations. Therefore, what's important is how the results come out in the next earnings announcement and the one after that, and how much the guidance is revised upward. Depending on this, this controversy will come to an end. I'll wrap it up here. The last content prepared for today is today's United States stock video. In today's video, Jim Munster, one of America's top experts whom I trust greatly, appears. Today, Jim Munster shares his opinion on Alphabet Google stock. Right now, Google's momentum is absolutely overwhelming. Recently, artificial intelligence beneficiary stocks like Nvidia have attracted widespread enthusiasm. Their stock prices have been underperforming. Amid all this, Google was the one stock that stood out with unmatched strength. Its momentum is excellent right now, supported by strong fundamentals. In fact, it's shown an increase of almost 100% over the past year. It would be good to check through this video how long this rally in Google stock can last. That's all for today's Big Stock News on November 25th. It's been a while, but the United States stock market surge has really lifted the mood. Anyway, I hope this rebound leads to a trend reversal. Tomorrow, I'll greet you again with a collection of various useful information that can help you with your investment activities. Let's keep working together until we retire through United States stock investing. Have a great day. Thank you. The next guest says that Alphabet will be the best stock among the Magnificent Seven next year. Jim Munster is with us now. That's a very bold claim. Why do you think so?
There are two reasons. The first reason is that there was pessimism that Alphabet could fall behind in the competition as people use search less because of generative artificial intelligence, but this concern has essentially been resolved. In the June quarter, search growth accelerated again, while in May it surpassed Wall Street's expectations by up to 300 basis points. In other words, as Google absorbed the new demand from people looking for information, it means they're successfully converting it into search revenue. The second point also relates to why the stock price rose today. This time, it showed that Gemini, which was unveiled, can compete head-to-head with OpenAI in the field of large language models. It's a very positive sign for investors that the company's competitive DNA has come back to life. The reason why this is important is because next year, the deployment of new chatbot-based services will become much more full-scale. Right now, only about 20% of Google users use chatbots on a daily basis. That means there is still a tremendous opportunity left. If the number of these users increases, Alphabet's valuation is also expected to rise naturally. Like this.
Wouldn't you say we could see it that way? As ChatGPT spreads widely, more people are drawn to it, and if that happens, it could take away the impact that Gemini 3 might bring. And Alphabet's stock price has already risen tremendously. Aren't many expectations already factored into the stock price?
Then I'll start with the second question. Alphabet is now trading at about 28 times its expected earnings for the next 12 months, nearly matching MAGX and Godduwawa. One stock is about 170 times, so it should be excluded from comparison. It's true that the stock price has risen a lot, but thanks to the recovery of search competitiveness I mentioned earlier, you can see that the valuation has returned to a normal level, so it's a natural trend. Moving to the question of spreading power, Open Artificial Intelligence has built its brand very well. It's the first name that comes to mind when you think of chatbots. Trying to use Apple's distribution network was a smart move, but it hasn't made much impact yet. Of course, there will be another chance when the new Siri comes out next spring. On the other hand, Google's reach is a habit in itself. There are 2.5 billion people who use Google search every day, which is the estimated daily active users of ChatGPT. OpenAI says the number is 800 million, but by my calculations, the actual daily users are less than that. In the end, if you look only at the spread, Google is already deeply embedded in our daily lives, so I think it has a much stronger competitive edge. One is
very young, while the other is an impressively mature service. Of course, it's natural for those kinds of numbers to come from a search engine that's been around for a long time. That's especially true compared to Open Artificial Intelligence is artificial intelligence. Another thing is that Alphabet's forward multiple of 30 times is quite high compared to the historical average.
That's right. If you look at the historical average, Alphabet's multiple was around 20 times, and the 5-year average was about 23 times. So it's clear that it's higher than that right now. But I don't think it's expensive enough to say it's overpriced. There has been some valuation expansion, but there's also room for profits to increase in the future. And going back to the discussion of old versus new, from a brand perspective, open artificial intelligence and ChatGPT are definitely part of a new generation. Google might feel like a slightly outdated brand, but in the end, Google is a habit for people. These days, when you search, you probably see an artificial intelligence overview and an artificial intelligence mode button popping up. What if Google starts gradually guiding this traffic into pure Gemini mode for fun? I think they could create a large consumer subscription business worth $20 a month. For reference, about 80% of OpenAI's revenue comes from these kinds of consumer ChatGPT subscriptions. So I agree that the brand is old, but at the same time, I think that very habit is a big opportunity for Google.
Japan. Shall we listen to Satoma? Happy investing, supporting each other's dreams, going down a beautiful downhill road together. Walking along, happy investing, with Miju, all of us, until the day we boldly retire with domestic stocks.